Hello, Team 201. We're in the home stretch looking at the conceptual framework, and the last chapter we're going to look at is the one that discusses presentation and disclosure. And this is also something that's new to the framework that hasn't been really addressed in the past. I don't think you'll find this section too challenging, but before we dive into it, let's just position ourselves again what we've done so far. So remember, with your conceptual framework, you're all about providing useful information to the users of the financial reports that you're preparing. And to make information useful, we've got all these qualitative characteristics that we apply throughout the entire process, from deciding what the reporting entity is, to doing the classification as an element, to doing the recognition in a journal, and then to the measurement as well. So the next step now is to take all these journal entries that we do and then actually present them to the users, because you can't provide your users with 100 journal entries or 100,000 journal entries. You need to consolidate that in a concise report that you can give to them that's useful, that can influence their decision making. So this section starts introducing that and tries to give us a few concepts in terms of what to look at with financial reporting. And again, when you look at these things, remember your qualitative characteristics pervade it all. It's all about giving relevant information and faithfully representing the economic events the best you can. So you'll be familiar, as I said, with a lot of these sections. The first thing I want to just refer to is the whole principle of recycling. That's something that I wouldn't worry too much about now. I would read through it, have an awareness of it, but it will come to life later on during your studies. It's not something that we really fall back on in the second year accounting module. The one that I do want to spend a little bit of time on is other comprehensive income. This is something that's been introduced over the time and was never in any of the previous frameworks. And the board has brought it into the framework now. And the reason they did that is there's always been a lot of criticism of the ISB about this other comprehensive income line item. So basically what other comprehensive income is if you picture your statement of profit or loss, that usually should end with profit for the year, profit for the period, right at the bottom, the profit after tax. But over time, another line's been introduced by the ISB, and that's been other comprehensive income. So it's something that they felt wasn't in the profit or loss section, but is in the income statement or the statement of profit and loss and other comprehensive income. But they didn't want it affecting the profit for the period. And people started really asking questions about what is the conceptual base for this? Are we not just subjectively deciding that some things we don't want in profit or loss? So a bit of history on this is with financial instruments, there was an instance many years ago with the financial crisis where the French banks were really upset with fair value adjustments on investments they were holding, moving through their statement of profit and loss. At that point, it was called the income statement. And the problem is the movement on those investments, the fair value adjustments would go up and down. And it was a graph that was going all over the show. And that makes investors nervous when a business reports earnings that are really all over the show. Most investors would prefer a comfortable, nice, straight upwards line. So the rumor has it that the French banks and the French government put pressure on the ISB that said to the ISB, if you guys don't take this volatility out of our profit figures, we as a big member of the European Union, who is probably the ISB's biggest client, are not going to use IFRS anymore. So then the IFRS, because of that pressure coming onto it from the political side of things, they moved some of these once-off transactions that would cause these anomalies in profit out of the profit for the period and put it below it as an extra line item. So there you've got an example of, we have this whole conceptual framework, but some political possibilities have influenced how we do things. So that was the rumor that's come over time. And you know how these things get tails over time and become bigger than what they were. But I think it's also important to understand that going forward, when you're looking at standards, the conceptual framework gives you the ideal answer. But unfortunately, the world is not perfect always, and there might be other pressures and interferences that come into standard setting as well, which we need to guard against, and we need to help the ISB be able to stand up to, that we give relevant and faithfully represented information to the best of our ability all the time. So now with the 2018 framework, the ISBs tried to bring this other comprehensive income into the framework. But if you go through that section and read it slowly, I'm not convinced there's still a conceptual basis for this thing. The board has pretty much just said when they feel it gives relevant and faithful information, they can prescribe through a standard that you use other comprehensive income for a particular movement rather than having it influence your profit or loss for the period. So just a heads up on this, it's something that we are battling with in financial reporting. And over time, it's going to be something that might be of real interest to you. So that, I think, brings us to the end of our video series on the conceptual framework now. And just to finish off on our last screen, to bring it all together, remember, it's about useful information to the users of financial statements. And how we got there was using our qualitative characteristics, going through what the reporting entity is that I want to report on, the period we're reporting on, what are the economic events that I've transferred and classified into elements, I've recognized these elements, I've measured these elements, and then I've ultimately reported these to the users in the statement of financial position or profit and loss in the cash flow statement or the notes. A word there, just as a heads up going forward, remember, when we talk in financial reporting about presenting, that means we're showing the numbers in the actual financial statements, not the notes. So in the SFP or in the SPLOCI. When I'm talking about disclosure, that is something that goes in the notes.